Here we are on India tonight, and of course it's raining earnings within the IT pack as well. We've got a slew of earnings to go through. The latest, of course, is IT giant Tech Mahindra. They reported first quarter numbers earlier this evening. The consolidated profit after tax for Tech Mahindra has come in at 1,130 crore rupees, and the revenue for the quarter for the company has come in at 12,708 crores, which means it's up 18% on a year-on-year basis. Of course, it's a slight miss on the EBIT margin this time. An attrition rate has come down for Tech Mahindra to 22% versus the 24% that was reported in the previous quarter. Let's get the complete picture. My colleague Anisha Jain is joining us. She's going to walk us through those key numbers getting reported by Tech Mahindra not too long ago. Anisha, on the face of it, the optics, and if you dive a little deeper, what do these numbers of Tech Mahindra say for the quarter gone by?
Well, Tech Mahindra reported an overall mixed set of numbers, bang in line with what the other IT companies have been reporting. While the top line growth was strong, its margins, which is a miss. Now, in terms of details, the constant currency growth came in at 3.5% versus our expectation of a growth of 2.5 to 2.8%, and consequently, the dollar revenue growth at 1.5% was also better than expectation of 1.1% growth. The EBIT margins, however, have come in lower than expectation. There's been a decline of almost 230 basis points. We were working with a number of around 11.3%. Separately, as a result of all of this, the profit figure has been in line with expectation at 1,130 crores. In other internals, the deal wins have been steady at $800 million, in line with what the company's quarterly run rate has been. And the commentary regarding profitability is also optimistic because they expect profitability to improve from here on account of the levers that they have. Attrition has moderated on a quarterly basis, and the headcount addition of around 6,800 continues to be on the steady side. Overall, a mixed set of numbers coming in. It's only the BFSI segment which is a bit sluggish, a quarterly decline of 3%. But other than that, manufacturing, technology and retail have participated well.
All right. Thanks very much, Nisha, for walking us through Tech Mahindra's numbers. In fact, it brings us slam dunk in the middle of our big story tonight. The five tech giants, if you consider TCS, HCL Tech, Wipro, Infosys, and the latest numbers that have come out for the first quarter, if you consider all of them, largely the performances of TCS, HCL Tech and Wipro, they have been a disappointment. Attrition and margins, they've remained a key issue for all these IT companies. EBIT margins have also disappointed. So before we dive into this trend that is building up within the IT sector, let's just get a word in from the managements. What have they been saying by way of their commentary so far?
We believe that the EBIT margin at 11% is the lowest that we will see. And it is a result of us investing ahead of time.
We expect attrition to be at similar levels or maybe little higher in the coming quarter, but then after that we expect it to go down.
Last quarter we ended up an LTM attrition of 21.9%, and this quarter it is 23.76, almost 180 basis points increase. We still see heightened attrition. Next quarter also will remain more or less same.
We keep our margin guidance at 21% to 23%. With the increased cost environment, we will be at the lower end of the margin guidance.
Our Q1 operating margins, as anticipated, were lower at 15%. And this is because we are investing in solutions and capabilities.
All right, so that's a word coming in from the managements, and of course they are across the board within India's IT sector, and the large ones are the ones that we are talking about over here. They do have exposure to the US markets in a big kind of way, and of course when there is a concern when it comes to the possibility of a recession in the US, how is that likely to impact Indian tech companies? Already you're seeing profitability is under pressure. You're seeing margins come under pressure. You're talking about the overall picture when it comes to attrition as well, not looking the most solid. So let's get perspective on this. What's the road ahead looking like for the IT sector with the prospect essentially of a US recession. For that, Mahantesh Sabarad is joining us, an independent market expert. Great to have you with us, Mr. Sabarad. Now, India's Nifty IT index, if you were just to look at them, which tripled between the onset of the pandemic of COVID-19 in March 2020 and the end of last year, has actually slipped as much as 27% in 2022. So, notwithstanding the earnings that the IT sector has put out so far, Infosys, for one, has made a rather positive, very optimistic sounding forecast of 14 to 16% annual revenue growth. Do you think this can hold true if you do get hit by a US recession? Because clearly, the company does not believe a US recession is coming just by looking at their projections.
Good evening, Vikram. Thank you for having me. Let me just answer by saying that the US recession is something which is still debated. In the sense that while some may argue and say that 2 consecutive quarters of decline in the US GDP constitutes a recession, not all economists would go by that formula. Having said that, you should understand the Indian IT services are exposed to the US market to a large extent, but they do have other sources of revenues coming in from such economies as the European economies and even locally. Also, at the same time, the exposure that they have in terms of sectoral breakdown, you will notice that the primary exposure in the US market is from the BFSI segment. So the BFSI segment is something which is quite resilient to the recessionary forces that prevail in any normal economy. Usually you will find the retail segment bearing the brunt the most, not really the banking BFSI sector. So therefore, I would reckon that what Infosys is trying to tell us, and I would say that they are pretty honest about it, is that the growth that they are likely to see ahead has been a function of various deal wins that they have been having over the past years or so. The last fiscal year ended with deal wins of most IT companies growing in the early double digits. The year before that, the deal wins were growing even much stronger, upwards of 15% year on year. These deal wins translate into revenues in the subsequent years. That's the phenomena that we're going to see. So to me, number one, US economy going into recession is something which is debatable. And I do foresee that on the top line, at least, most of the IT companies should be able to grow quite strongly. When I say strongly, they will hit the double-digit mark in terms of growth rate year on year.
You did mention sectors, Mr. Sabarad. So outside BFSI, which you said remains pretty resilient, even if we do get a recession, the exposure that Indian IT companies have to manufacturing, to retail, also something that you addressed, healthcare, utilities, are we likely to see a backlash because of that? The deal pipelines, when you consider them on an overall basis for the Indian IT sector, these sectors outside BFSI, how likely are they going to be impacted?
So there is another phenomena I should also touch upon. You will notice that the digital revenues of most IT companies have been growing quite strongly. So much so that now they constitute the major portion of their revenues. This digital revenues that they are sourcing is essentially cloud-based, and we are seeing a huge development that is happening in terms of apps around cloud infrastructure. In fact, if you look at Gartner's prediction, while they do predict that the overall IT spending globally is slackening or slowing, that on the cloud infrastructure is growing quite strong. If I'm right, their latest prediction talks of 2022 year growing by as much as 11.2%. And within that, the services related to cloud infrastructure should be upwards of 6%. If that is so, then Indian IT companies shouldn't have any reasons to worry as far as the top line growth is concerned.
Fair enough. So digital revenues have been on the rise, but profitability is shrinking across most IT firms. Infy, Wipro for sure. At TCS, it seems flattish at best. Do you see customers of India's IT sector using the decline of the Indian rupee against the US dollar? I mean, it's declined nearly 7% this year. So there is a possibility that they'll use it against Indian IT companies to bargain them out of raising the dollar price of IT contracts, because there is definitely an exchange rate advantage that Indian IT companies have there.
Yes, you are right. We have seen the Q1 results of most IT companies showing the margin pressure. In some cases, we have seen the margin pressure to be as high as 2 percentage points, 200 bips. You have this pressure coming in on the margin side, not only due to pricing pressure that you alluded to, it is also coming through pressures on the manpower side. You have to deploy a lot of your manpower on site. And with the rupee getting depreciated, your expenses obviously are dollar denominated. They go up. And there is little that the IT companies have in terms of lever to compensate for this rise. What they can do is somehow hedge their positions such that the rupee depreciation effect is postponed by a quarter or two.
Fair enough. But even as you see the manpower issues rising when it comes to rupee costs for IT companies, which are going up, you do consider travel, visa expenses, the employees who are now seeking dollar wages because they see the advantage over there. In general, in inflationary times, for retention, all those rising wage costs invariably are going to go up. How do you think the manpower issues are going to pan out for IT companies? Looking at the possibility of a US recession, the inflation conditions in India as well, do you still think it's possible for them to get the kind of manpower they did for their on-site requirements?
So, there is a problem, not really in terms of the rupee depreciation per se, which I did talk about on the manpower side. The problem has got to do with shortage of skills, shortage of requisite IT talent that these companies seek to have. And that is why we see the attrition rate is pretty high. One other interpretation of the high attrition rate is that these IT companies have been preparing for an eventuality that says they will require more and more and better skilled talent, and they are in the process of doing exactly that. While they therefore recruited much in advance in terms of their bench strength for having that requisite IT skills, they are now faced with the consequences thereof in terms of high attrition rate. It does add to the cost. So I'm not denying it and saying that margin is something that can be warded off. But what I do feel is that probably the worst of the margins that we have seen in the Q1 so far is something behind us. Probably Q2 could also be worse in terms of margins, but they do seem to point out in terms of their guidance that the margins will improve henceforth. That's why you see the margin guidance of some of the companies are also explicit by saying that they will be doing better than what they've achieved right now, or marginally better than what they have done.
So, Mr. Sabarad, you feel that at this point in time, the recession fears hitting the IT sector hard, you don't think that is a clear possibility? It's not a given as of now, despite the kind of pressures that we're seeing elsewhere play out. But the IT sector has been beaten down if you look at their performance, the stock performance in recent times. Do you think some companies are going to play this better and that's going to reflect in the stocks that we are talking about? Would you bet on any of them right now from a medium to long-term perspective?
See, wherever you find the guidance from the company talking about revenue growth in excess of 15% on the top line, or even if they don't explicitly talk about a revenue growth guidance of 15%, but are confident of achieving a higher growth number, I think that's reason enough to bet on those companies. Because from a trade-off of the valuation fall that we have seen thus far versus the growth ahead, the growth trade-off seems favorable for these IT companies. So you have to be pretty sure in terms of how the growth is going to pan out. It comes from the guidance, of course. It also comes from the deal wins that they are reporting from time to time. So over a period of time, I do believe that you will have a chance to get into most of these top-rung IT companies at fairly low valuations.
Now, you'd rather wait and watch for a bit. Is that the word, Mr. Sabarad? That at this point in time, if you do have the opportunity, if you are sitting on a potentially strong investment possibility, IT is not the way to go. And if so, if you think otherwise, then which are the stocks that you would bet on?
So, since most of these companies have announced their results only recently, you should allow some time for the stock price discovery to happen, valuation to really settle. That's the reason why what I meant by saying wait it out for a while. But when I say wait it out for a while, it's not potentially waiting out for a quarter or so. It's probably a month or so. Having said that, the best way to play the IT sector has always been through the large IT companies, because the key feature you will notice in large IT companies, unlike the smaller IT companies, is that their margins are fairly resilient. Even if we have seen this quarter margins to drop or dip by over 100 bips on an average, the mid-size or the smaller IT companies typically report much higher margin compressions in the range of 300 to 400 bips or thereabouts. So there is a double whammy effect that you will see on mid-rung IT companies. There is a margin compression which is very large. At the same time, their ability to grow on the top line is pretty much constrained. Therefore, I would remain, invested as the sector weights are in the large indices for the IT companies and invest along that line. That means essentially we should be equal weight on the IT sector.
Fair enough. Mahantesh Sabarad, the independent market expert, sounds pretty positive about the IT sector, despite the headwinds right now that it faces with the possibility of a US recession. India's IT firms, of course, they can only hope that a full-fledged US recession doesn't hit the economy. And of course, the US is arguably their most important market. So the question that remains is that customers who ramped up their digital budgets during the pandemic, will they keep the order pipeline going or not? Will they keep it as robust? And that's the question that we'll be looking for answers for. But thank you very much, Mahantesh Sabarad, for joining us with your perspective on this.